Inflation is the general rise in prices in an economy over a specified period. The Federal Reserve typically targets a low and stable rate of inflation of about 2%, which can signify a growing economy. But inflation can creep into the double digits as a result of economic shocks. Inflation has fluctuated throughout history. During the 1970s and 80s, prices increased from 10% to 15% in some years. Since then, inflation has cooled off. In the 2000s, inflation rates fluctuated between 2 and 5%, while in the 2010s, inflation hovered between 0% and 2%. In other words, prices have been remarkably stable in the recent past compared to other times in history. Recently, however, inflation has re-entered the conversation. For the 12 months that ended in July 2021, inflation clocked in at 5.4%, one of the highest rates in many years. Then how do people earn during inflation? It's best to ask rich people because they always manage to get money out of every situation. Welcome back to the Wealth Academy channel. In today's video, we're talking about 5 ways rich people make money with inflation. Before we start, make sure to subscribe to our channel and press the bell to be notified when a new video is online. If you've done this and you're ready for today's topic, we can get started. Here are the 5 ways that were mentioned. Number 1. Real estate. Many factors influence the price of money, and the majority of people are unaware that currency is simply another commodity on the market whose value is decided by demand and supply, among other things. Consider a hypothetical scenario in which you have $10 in the entire economy on one side and 10 residences on the other side of the table. According to this hypothetical scenario, a single house will cost $1. However, if we pump an additional $10 into this market, there will be $20, but there will still be 10 houses, which will enhance the price of houses in a market where a single house will cost $2. That's a straightforward explanation of inflation. Single-family homes financed with low fixed-rate mortgages tend to perform well during periods of inflation. As inflation climbs, your property is likely to appreciate while the monthly service cost of your mortgage stays the same. This is at the very heart of building home equity, which can rapidly increase your net worth. By purchasing real estate, you're also insulating yourself from rising rents. Like any other consumable good, rents tend to rise during inflation surges. Even though mortgages are less flexible than rental agreements, they have an advantage when inflation is high. Number 2. Value stocks. Stock prices may not have soared by several thousand% as much as cryptocurrency values, but they are considerably more stable and less dangerous investments. From July 2020 to July 2021, the S&P 500 index increased by 40%. That's an incredible rate of return, especially considering that you are investing in the entire U.S. economy. When you purchase a stock, you're effectively purchasing a piece of a company. It's for this reason that they're referred to as shares. When there's an excess of cash in the economy, the value of a particular firm increases, and you grow along with it, thus increasing your wealth. Moreover, because that money is typically spent on necessities and wants, businesses grow faster as a result. As a result, you're not just combating inflation, but also gaining from it. Consider for a second how much of those stimulus payments were spent on things from Amazon or Apple. If you take into consideration the fact that these corporations have received billions of dollars in loans essentially for free and have grown at an exponential rate, the economy is reopening, people are spending more, and these businesses are poised to develop even quicker as a result of the return to work of the populace. Keeping your money invested in assets that are hedged against inflation is the most important thing you can do. The majority of wealthy people do not have much cash on hand. Typically, they preserve a little portion of their net worth in liquid assets in case of an emergency. Take, for example, the world's wealthiest individuals. They have become so wealthy as a result of their ownership of a specific percentage of the firms they've created. Number 3. Commodities. Commodities include gold and other precious metals, as well as raw materials and various natural resources critical to production. Simply put, as demand increases, prices rise in the economy, and the cost of production to meet that demand typically rises in lockstep. Commodities are generally seen as safe haven assets during times of uncertainty. While commodities don't pay dividends or represent any underlying business, they are uncorrelated to the traditional asset classes of stocks and bonds and tend to move in an unrelated direction. Number 4. TIPS. Treasury Inflation-Protected Securities, or TIPS, are marketable U.S. Treasury securities aimed at combating purchase power erosion. TIPS has the advantage of periodic inflation adjustments, a characteristic that standard fixed-rate bonds lack. Investors seeking capital preservation and purchasing power stability should take a look at TIPS as part of their lower-risk portfolio segment. TIPS holders can enjoy the confidence that they'll get their principal back, given that TIPS are backed by the full faith and credit of the U.S. government. Number 5. Debt. Many of you hold a negative view of debt. However, debt can be beneficial in certain circumstances, particularly when there's an increase in inflation. It's possible that $1 now will be worth more than $1 tomorrow. That means if I borrow $1 today and return it the next day, I will have made a profit on the transaction. Currently, the median housing price is roughly $350,000, but it was less than half that amount 20 years ago at around $150,000. Because the real value of the dollar declines year after year, the same $150,000 that was worth $350,000 20 years ago is now only worth $150,000. That's why when the Federal Reserve dropped interest rates and began purchasing corporate bonds, guess who was the first to borrow all of the money? Amazon, Facebook, Microsoft, Apple, and other world-leading corporations receive significant sums of money, even though these organizations do not require the funds. Apple has amassed a fortune in cash, estimated to be worth over $200 billion. However, it still borrowed money because why use your own money when you can just dump your money into the S&P 500 and receive at least a 10% return, while borrowing money at a 1% interest rate is beyond comprehension. By investing that borrowed money into your business, you may still generate a 4% profit even if you get a 5% interest rate on that loaned money. Furthermore, when you borrow money, you're eligible for all of the tax benefits listed above. As a result, you'll save money on taxes as well. If interest rates are lower than the rate of inflation, whatever money you borrow is theoretically generating a profit for you. This is what we came up with through our research. We hope you all understand the essence of inflation and all the ways you can profit like rich people. So, what do you think? There is a section for comments, so please write it there. We'll be happy to read all of them. Of course, don't forget to like and subscribe to our channel. Also, turn on the notification to never miss upcoming videos. We hope you enjoyed this video. See you again soon.